Good morning, everybody. It is Monday, February 23rd, in fact, and here is what is on your agenda. US tariff policy in flux, stocks, futures and the dollar don't like the uncertainty, and oil drops as we're still watching Iran this week.
European futures then, pointing lower by 0.4% on that uncertainty. Anna, after record gains, a fresh record on Friday for European equities, the same picture coming through for US futures. Also risk off on the tariff uncertainty, pointing lower on the S&P EMEs by 0.6%. As you look for havens, see the gains for the yen, for the Swissy and for the euro as well. Dollar is down sharply this morning and currently off by 0.3% versus the single currency. The countdown to the opening trade starts right now.
Today I will sign an order to impose a 10% global tariff.
Became 15 pretty quickly. Did you watch that press conference? Amazing. Just how annoyed the president was at what had just happened with apparently his Supreme Court. Not a happy man. Went from 10 to 15 pretty quickly over the weekend. I'm still trying to figure out why it went from 10 to 15, but we'll park that one for the time being. So we now have 15% tariffs, 150 days. This is under Section 122 of the 1974 legislation. That's going to be probably appealed against as well, but they're going to get other tariffs in place while we wait and watch. The rest of the world is trying to figure out what's going to happen. The UK looks like it's something of a loser. The EU's thinking about pausing its negotiation. Market's sitting there, kind of trying to figure out what to do next. Feels like risk off, but I'm not sure how risk off.
Yeah, I'm not sure either. And we still have a lot of things we just don't know the answer to. Yeah. Is that the extent of it? Like you say, it looks as if the UK and Australia could be losers out of this, but only at the margin. And then the winners could be predominantly in Asia. We've seen some of the market response to that. China, Vietnam, India, Brazil, Indonesia. But as you say, these are temporary tariffs, 150 days. There's a suggestion then over the weekend that we get further tariffs that could even take us to higher tariffs overall for the US. That's certainly from Scott Bessent. But Morgan Stanley saying the peak level of uncertainty on tariffs and trade tension has passed. Doesn't feel that way looking at futures this morning, but we'll get to that.
Yeah, and the Morgan Stanley view as well on the tariff impact on Asia being pulled lower. Asia is a beneficiary in terms of the equity story today. The emerging market trade, softer dollar is beneficial there as well. The bond markets of emerging market world are doing quite well. When you bring it back to what's happening with UK, we had this preferential deal of 10%. Do we get 15% even over that 150-day period? The UK is going to be on the phone to the US, but how much and where are we in terms of the list of priorities as the US administration tries to adjust to what is clearly a significant blow from the Supreme Court in terms of their tariff agenda?
I think everybody saw this coming. The president was... there was an unbelievable press conference to watch. Even my kids are watching it just with their jaws on the floor, kind of listening to what he was...
That's an interesting Friday night.
It was, yeah. I was watching it and everybody came in and watched it. I was like, OK, cool. So what happens to existing trade deals, I think, is interesting. What happens to US finances, I think, is interesting here as well. And how this rebate story works. Don't know. I don't think US corporates know. But that's where I think the uncertainty comes in. Yes. It's just kind of how does this translate into reality? How long could that process be drawn out for? Yes,
there could be a lot of challenges in court, as you said. The Section 122, does that take us into a court situation very quickly? And then if you're looking at refunds and rebates, that could end up in court for ages in terms of who in that supply chain ends up paying for this. But let's go to market reaction and a quick mention that we've got fixed income markets opening, treasury markets opening because Japan was closed. So the London trade is the first we see of this, and yields just a little bit lower. Not at the long end, though. They're pretty flat, actually, at the long end, and that's where a lot of the focus perhaps will be, and we'll talk with a fixed income guest later about that. But more broadly, we do see risk off. We see US futures are weaker, stock futures down 0.6% on E-minis. European futures are weaker, but they're off their earlier lows, and I don't know, the Friday reaction was kind of, OK, well, this is better than maybe...
10% was better than 15.
Right, yes, 10% was better than 15, but then we got 15, and that was after the Europeans shut up shop. So maybe we're pricing in a bit of that. Doesn't really explain why we're so risk-off about American stocks.
But if you take I'm not sure we are, because if you take the two-day E-mini futures, S&P mini futures, Friday into Monday, we are up by 0.1%. So, i.e. no change from the start of trading on Monday.
So should we instead be looking at the dollar? Should we instead be looking at treasuries? Because we also had sticker inflation with PCE data out on Friday. We've had Fed members talking about rate hikes. We've got a more stable labour market, it seems, in the US. Is this the moment where treasuries start to sell off and we're challenged on the levels that we've seen, given the run-up in terms of gains for treasuries in recent weeks? So is that the pain point, particularly on the question mark about additional revenue? Scott Besant saying, don't worry, we'll still have those revenues. And the other debate we've been having after April and Liberation Day was, is it better to have certainty for businesses but a higher tariff rate, or uncertainty even if it means lower tariffs? So nominally we're at lower tariffs right now, but the uncertainty level has just ticked up. So what is worse and what is better for businesses remains a debate.
And is the stronger euro a negative for European businesses? Because your point, Tom, we seem to be getting some flow into the euro this morning.
Can't figure out Bitcoin. What's Bitcoin? Bitcoin, in theory, should have been our guide over the weekend to what was happening. Didn't move very much over the weekend, and then come in on Monday morning, straight down. So I don't know what you tie that to. Is that just a positioning story? Is that something else? Is that just an unrelated trade being put on this morning?
65 is hovering around 65,000 on Bitcoin. It had crossed to 64. Some saying that 60,000 is the next level to watch.
We bounced off that once.
Yes. So you get to 60,000. Is, how much support is there around that level? But to your point, what is the structural play around Bitcoin? I mean, no one seems to know at this point. Oil, interestingly, is down. Brent is down 1%. The New York Times is reporting that the Trump administration is considering a limited strike following by potentially a more significant strike. But maybe the oil market is adjusting to the news that they will be, in theory, the two sides, Iran and the US, meeting in Geneva this Thursday, and the Iranian foreign minister speaking constructively about the chances of a deal. But the military build-up has not reduced. It has increased. So we look to Thursday.
Is this one of these situations where you watch what people do rather than say? Because if you watch what people say, then everything looks OK. If you watch what people do, then it isn't. Like there's stories about, in the FT this morning, about handheld surface-to-air missiles being acquired by Iran. You've got a huge military build-up. Is that what you watch? Or do you watch what the chat is, which is, we're going to get a deal, we're going to talk? Because they're telling very different stories.
And a lot of the conversation over the weekend seemed to be the extent to which President Trump is prepared to use the military that he has, to such a huge extent, assembled in the Middle East. Because a lot of people pointing out it can't stay there forever. No. It'll have other things it needs to be going off and doing. So what is he intending to do with it? Is it really just a pressure to get to a deal? Will that deal be narrow? Will the pressure to get to some kind of deal involve a targeted, small-scale strike? The risks of that getting out of control, though, are clearly there. But will this be an administration that's emboldened by targeted strikes in Yemen, in Syria, in Nigeria, and of course, obviously, in Venezuela? Will it be sort of emboldened by that kind of strategy and try to replicate something like that?
And how willing is OPEC Plus to fill any drop in production out of Iran? Are they standing on the sidelines ready to put more barrels of oil into the market? And how do they get that oil to market? And do they have the capacity to ramp up supply to meet the potential drop?
Depends on the Iranian response at that point and what it does with the Straits of Hormuz and whether it targets facilities in the region. Trump's strategy, though, up until now has been to go really big with just about everything and then wind it back down. Can I apply that to the military as well? I don't know. There's a lot of servicemen kind of in the region at the moment. As you say, they can't be there for long. So how long does this threat exist for? Can it exist for?
Yeah, absolutely. And a lot of the talk over the last couple of weeks was, this is ahead of the midterms. This would risk pushing up oil prices too substantially. But we will see whether there is a different way of thinking about this as we get through the week. Thursday, very much in focus with that in mind. Let us tell you about some of the conversations coming up on the programme. We are going to be thinking about trade, of course. Crawford Falconer will be joining us, Bradshaw Advisory Senior Advisor and former UK Chief Trade Negotiation Advisor. That conversation important when it comes to the trade narrative. Where does this leave the UK? But also we'll talk the broader global themes. Christel Hydermann will be with us, the Orange CEO. Now, they've just put out results, just had a conversation with investors. What does consolidation within the French market really mean for pricing power in this business? Gerry Fowler, UBS Investment Bank, Head of Global Derivatives and European Equity Strategy, will be with us at the start of European opening trade for this week. And Angelina Valavina will be with with us. Fitch Ratings, head of EMEA Natural Resources and Commodities, to look ahead to Thursday, that meeting between Iran and the United States, and to think about how oil navigates the choppy seas before and after that.
OK, some of the guests coming up throughout our programming. Here's what else to think about when it comes to the earnings week. Another big week for earnings. On Tuesday, we're going to get some numbers from Standard Chartered and Telefonica, also, of course, in the telecom space. On Wednesday, HSBC in the banking space, Novo Nordisk, Bayer, Leonardo in defence, and in the US, Nvidia. That is the big one. Joby Aviation, Salesforce under pressure as a result of the AI SaaS apocalypse. Paramount Skydance as well, and that deal of business focus as well around Warner Brothers. Thursday, the London Stock Exchange Group, LSEG, Allianz, Schneider Electric, Rolls-Royce, Stellantis, Hensoldt, plus earnings from Baidu over in China, Dell and CoreWeave. And on Friday, Holcim, one of Anna Edwards' favourites in the cement. It's a cement story, isn't it, really? Swiss Re
no
and IAG. But I think our attention will be certainly drawn to Nvidia. The last two quarters for Nvidia, the market reaction has been negative, despite pretty decent numbers. And so there's the build-up, as always, to the Nvidia earnings story, but particularly acute, given those question marks about the $650 billion capex spend and whether that is sustainable.
The analysts are talking about this could be another beat and raise quarter, but will that have anything to do with the market response we see? Or will the market be underwhelmed or distracted by other things?
Look at that chart.
Yeah, it's gone nowhere.
It's gone nowhere since August. Amazingly tight range since August. What does it have to do to get itself out of that range?
Yeah. Would you remember a year ago we were asking questions around Nvidia earnings quite regularly? What will happen if the bottom falls out of the AI story?
Yeah.
You know, define that as you will. And how on earth will markets survive? Because we'd relied so much on AI, that particular part of the AI narrative. Well, stocks didn't drop. We've seen a huge amount of rotation within the AI space, but stocks overall have actually been quite resilient to Nvidia going nowhere, haven't they? And Nvidia itself.
Stocks have gone nowhere at an index level.
Right.
So,
but neither have collapsed, I suppose. It sort of didn't look as if it could be something that came to an end gracefully.
Multiples on Nvidia are looking better because earnings are up.
Yep.
Valuation is looking less extreme. So for some,
you've got to believe in the ongoing hyperscaler spend story.
Yeah.
And if you're starting to question that, do you question Nvidia? Nvidia's also got much more competition in inference. So, again, there's that kind of angle to it, too. So there's a few challenges certainly beginning to raise their heads. OK, let's talk about what else you need to know this Monday morning. Hungary plans to block every European Union decision concerning Ukraine until oil starts flowing again through the Druzhba pipeline in Ukraine. Prime Minister Viktor Orbán says, quote, no war loan can go to Ukraine until oil deliveries to Hungary restart, referring to a €90 billion loan to Ukraine previously agreed by the EU. The pipeline system, which moves Russian crude to Hungary through Ukraine, was damaged in a Russian attack back in January, leading to a halt in shipments. Mexican authorities have killed a top drug cartel leader in a military raid in the western state of Jalisco. The government says the leader of the Jalisco New Generation, known as El Mencho, was killed along with 6 cartel members. U.S. officials celebrated the killing, which comes with Mexico under increasing pressure from President Trump to halt the flow of illegal drugs into the United States. But there's been dramatic pictures, certainly this morning, of what has been going on in Mexico in terms of the retaliation. More than 35 million people across New York and the U.S. Northwest are under blizzard warnings as a huge winter storm is forecast to bring up to 24 inches of snow. Schools are closed and streets and highways and bridges will be shut to most traffic from 9 p.m. on Sunday night, i.e. have been shut since then, until noon on Monday local time. Does this impact... This is a kind of... This is going to be a tough day in New York, and you can see what the weather looks like already, and it's sweeping up the coast. Is there a market story here? Is this effectively like a US holiday in terms of the volume story that we're going to be seeing going
the airlines, through? I mean, there's been a lot of flights have had to be rerouted or cancelled. A lot of train trips, of course. So there's going to be at least on the surface, there's going to be an economic impact as a result of that, and the fact that New York is essentially sealed off.
Yeah, and on the market side, yes, maybe lower participation if people have to do other things rather than be at their desks to trade. And also at the time when China is out and we're still not back to full complement in Asia, it does risk being one of those days where we don't get a full sense of where people's heads are at. Also, strange to think the middle of this week here in Europe is actually going to be really quite warm for February, so weird weather things happening.
But huge snowfall across the Alps and places like that over recent days, like story after story about what's been going on there over the last week. Some kind of weird weather.
Yes.
Let's
no more Winter Olympics. That's sad. Coming up on the programme, we will talk about Bitcoin, of course. It continues its slide, briefly dipping below 65,000 US dollars earlier. We will dig into the details of the crypto rout, what exactly is driving that and what maybe isn't. Plus, Oman confirms US-Iran talks will take place in Geneva on Thursday. We'll be speaking to the former British ambassador to Iran. That's Rob Macaire at 8:30 a.m. London time. Up next, we check in on the story of the day with regards to global tariffs, the global response to the US import tariff upheaval. We will be speaking to the former UK Chief Trade Negotiation Advisor, Crawford Falconer. He will be with us shortly on the programme. If you want to get involved in any of these conversations, IB plus BBTV Go is the function to use on the Bloomberg terminal. No snow in evidence here in London. This is Bloomberg.
We are in a period of extreme turbulence because we've moved from one regime to a temporary regime to a much more permanent regime. And especially for those Section 232s and 301s, those could be long lasting. So those might extend long beyond Trump administration.
And because it is this temporary nature, only 150 days, I think, it's to be seen whether, in this case, importers will bring a case knowing that this authority will soon expire in any event.
The U.S. absolutely has leverage, but the Chinese have counter leverage. The biggest win for both countries is to bring some predictability to the business and investment climate so companies know how to invest and they know how to plan.
Some of the Bloomberg TV guests out of Asia reacting to what we've had from President Trump, saying that he will now impose global tariffs of 50% as a result of what happened with the Supreme Court on Friday night. Joining us now to discuss all of this and how trading partners around the world will react is Crawford Falconer, Senior Advisor at Bradshaw Advisory and the UK's Chief Trade Negotiation Advisor between 2017 and 2024. Good morning.
Morning.
More uncertainty or less uncertainty now?
Oh, more uncertainty.
Okay.
No question about that. And to some extent, depending on who you are, it's slightly worse outcome. For the UK, it appears to be, for the time being, marginally worse. And for the Europeans, it's also marginally worse. So, that's just the reality we have to deal with.
Is it just 150 days? How do you see this playing out?
Well, they've claimed that they're entitled to use this provision in law. There isn't much point, I suppose, people like me saying, actually, I doubt whether it's legitimate, because they're going to use it anyway. I mean, it talks about balance of payments. It was written in 1974. There is no balance of payments problem in the United States. They might argue they've got a trade deficit problem, but that's not what a balance of payment was. Balance of payment was when you had fixed exchange rates. So I don't have much doubt, it's easy for me to say, that if you litigated this, it would probably say, well, hang on a minute, this authority doesn't apply. But look, it's supposed to last for 150 days. They're relying on it. Nobody will take a case in that period of time. So the reality is we just got to accept practically that that's what he's doing. Not that we necessarily accept it legally, but that looks like what they've set on doing, giving themselves a breathing space to try and plug all the gaps that the Supreme Court has put in their initial approach.
Good morning to you, Crawford. So just lingering on the UK for a little bit, because of your experience in advising the UK for some years. What will be the grounds of the argument? What will the conversation look like now between the UK and the United States? Because the UK, along with Australia, maybe looks as if it's done badly out of this. But is there going to be any time for that kind of argument in Washington?
There won't be much time, but I mean, of course, you make as much effort as you can, and you will try and get to as many people as you can to say that this is ridiculous, that we've ended up in a worse situation. But yeah, they're going to have everybody beating a path to their door. But I guess you just make the effort to do it, and whether or not that applies within the 150 days, at least you're preparing the ground for whatever regime comes in after the 150 days, if indeed there is one. I mean, I think the administration is scrambling. I mean, I don't think they've got a clear plan. They've been dealt a body blow. There's no question that there are limitations on what he's done. He can still go ahead with huge tariffs, But the revenue that they're getting from this has diminished as a result of this. Even 15% isn't 19%, which they agreed with the Indonesians or whatever. So I think they will take a while before they can try and plug those holes.
And President Trump clearly will be, well, he was clearly annoyed on Friday about the whole thing. They'll be thinking about what they do about the revenue stream that they'd attach to tariffs. They'll also perhaps be thinking about the foreign policy levers that this allows them or doesn't allow them to pull anymore, or at least not to pull so quickly. Is that going to be the biggest change that we see, or one of the big changes after this? Look, I think in many ways you could argue that the reason why the likes of the EU and the UK and perhaps some others haven't retaliated is actually because of their foreign policy concerns with the United States. And the equities that the UK and the Europeans have with the US in defence and security and with what's going on in Ukraine, I think is what has restrained them in how they've dealt with the US administration. And I don't think that changes. You can see that certainly in Brussels there is more obvious irritation with this than you're likely to see in London. And they will make those arguments on foreign policy grounds, as will we. But being able to get them to deal with this, if they say they're stuck with a piece of legislation that says 15% for everybody, will be an uphill struggle over the next few months. It seems quite unchanged from a European Union perspective, what they end up with. So is it...
Well, yeah, I mean, look, this is so wonky, but maybe Bloomberg can cope with wonkiness. I don't know. What they've done is they've said they've put 15% on top of existing tariffs. So if you have a 2.5% tariff on autos, which the US used to have, then it's 17.5%. Under the deal that they did with the Euros, it was 15% capped for the Euros. So they're paying another 2.5%, and that applies across the board. So they feel that they too have been hard done by in this deal.
Crawford, sorry, we have a deal. We have a UK-US deal. We have a deal. Why does that deal not hold in this scenario? Because you have an administration which, is completely unreliable when it comes to the regular way in which you do deals. I mean, and that wasn't exactly written on the back of a fag packet, but it's pretty close to it. I mean, there's no text. There's nothing that's gone to the US Congress for approval. So it relies on the administration's ability to deliver. And they haven't had the ability to literally deliver on this. So if you were sitting in Brussels or in Delhi right now, would you be advising lawmakers there to pause on implementation, which seems to be what we're hearing from Europe and India? Well, I think in Brussels, certainly the Parliament is taking the view, Langer and the Parliament is taking the view that they shouldn't, pass the legislation until the US clarifies its position. The UK traditionally doesn't do that. I mean, it kind of says we've got to try and make the best deal that we can. This is a little bit worse than what we've got already. Better not poke the bear. I imagine that will still be the position in London.
The press conference on Friday night, he was clearly very angry. Why do you think they went from 10 to 15 as quickly as they did?
I have no idea. I mean, when they said 10 on Friday, I thought, this is interesting. Maybe they've advised him that because it's across the board and because the UK and Australia have 10%, we better just go for 10, and that way we're not going to irritate our close friends and allies. But we've got to do an across-the-board one, so it'll have to apply to anybody. And then probably later in the day, he finally figured out that under the legislation you can do 15, and he probably said, well, hang on a minute, I could do 15, why have you told me do 10? I have no idea, but I mean, it wouldn't surprise me if it was something as crazy as that. And he sort of said, no, I want to do the maximum, let's do 15. Well, the Brits and the Australians are going to be upset. Well, too bad for them, they can just suck it up.
Yeah. Crawford, just briefly, I mean, what kind of chaos has been created at borders? Maybe not today, maybe today. I don't know. When does chaos at US borders ensue?
Well, certainly, it's probably not quite chaos. It's certainly confusion. And I don't see that changing. I mean, even though they'd done a deal, there are all sorts of weird things about the previous deal. I mean, you've got additionalities where firms in the US can sort of turn up and say we want to extend the restrictions on steel to the following manufactured items. So, the whole thing is pretty chaotic. There are exceptions. The only people making money out of this, it seems to me, are the customs officials and the customs advisors around the world who are trying to find ways to get through the back door. Yeah. Crawford, thank you very much indeed. Fantastic insights. Crawford Falconer, Senior Advisor at Bradshaw Advisory and former UK Chief Trade Negotiation
advisor. Coming up, a strong start to the year for French telecom operator Orange as the firm eyes high cash flow and cuts costs. We're going to speak to the CEO next. This is Bloomberg.
Good morning. How are you doing? 30 minutes to go until the opening trade here in Europe this Monday morning. Futures look a little bit like this. I would maybe argue that what you need to do is zoom out a little bit and take a look at the two-day charts on your Bloomberg terminal. We saw a rally into the close Friday. We've basically gapped lower first thing this morning. But actually, net, if you take a look at the Stoxx 50 two-day futures, you are still higher on that on a two-day basis. So we've unwound some of the positivity from Friday night and not completely unwound it, so we are still higher. The bond market looks
not a huge amount of action right now in the bond market. So we got treasuries. Treasuries are trading now. We had a bit of a delay as a result of a holiday in Japan. Yields are up. Yields are down. So the benchmark 10 years yielding 4.07. In terms of sovereign debt of Eurozone, we're largely unchanged on the benchmark 10-year Bund, as you can see, at 273. OATs in France also unchanged at 329. BTPs at 333. Not much activity in the Eurozone bond markets of note. The ECB's Christine Lagarde is going to be in Washington later, so we'll listen in, of course, to what she has to say.
OK, let's talk about the European corporate agenda, shall we? Shares in Orange are up 25% year-to-date. France's biggest phone company is now forecasting cash flow will rise about 12% per year, even as it completes expensive fibre upgrades and cuts costs. Joining us now exclusively is Christel, who's the Orange CEO, with us live on set this morning here in London. Nice to see you this Monday morning, Christel. Thank you for being with us. So you put out numbers last week, your corporate results, and also you had an investor day setting out new plans with regards to cash flow and the like. What's been the response from investors? This is a share price that has run a long way already. What are investors saying to you?
Well, first, investors recognize the success of our previous plan and then our ambitious agenda, including strategic moves. As we've consolidated Spain, created MasOrange, a leader in the Spanish market, which we plan to reconsolidate. We're growing big in Africa and in Europe, a more mature market. We're investing more on what we call Trust the Future around cybersecurity. And, of course, we have an ambitious agenda to continue to transform the company, to put customer at the center in a mature market, innovation and, of course, scale, benefiting from scale.
And is this going to be enough to provide another catalyst higher for the stock? I mean, I know you probably want the stock to just do what the stock does and you focus on running the business. But I asked this because CIC, one analyst last week, downgrading at the end of last week because of the big 60% run-up that we've seen in the stock over 12 months and suggesting maybe there's a lack of new catalysts. Grupo Santander, analysts there, cutting their recommendation to neutral from outperform. So I guess from analysts, just this sense of, well, can it keep on being this good in terms of stock performance?
Well, we're convinced of that. First of all, we're delivering and we have the success of, and we've proved execution. We have growth pockets. We are innovating. And in a very uncertain world, our plan is called Trust the Future. Why is that? This is very bold, but there's a lot of uncertainty. And we really are a resilient business, be it because connectivity will remain essential no matter what. AI, of course, is going to disrupt many industries. We're investing big on cybersecurity, on cloud, on trusted solution for our European and African customers, which we think is really a place to be these days.
What is the biggest growth driver then going forward? Is it cybersecurity? Is it Africa? Is it something else?
So Africa is absolutely growing double-digit for the past 3 years, when, of course, Europe is more low single-digit and will continue for the connectivity part of the business. Very, very competitive. We've been moving on national consolidation. We will continue to do so. We've done a lot of strategic moves in Romania, in Belgium, in Spain, and as you know, we're actively discussing in France for the potential takeover of part of SFR. Yeah. And of course, then the growth areas will be trusted cloud, AI, really focusing on providing secured and trusted services to our customers. In a very, again, uncertain world, AI is just accelerating the threats as well.
We want to get more of your views on AI, but as you mentioned the deal, SFR, what is the progress there? Are you getting closer? In that, there's three partners aiming to take over SFR, along with Bouygues. How close are you to getting a deal across the line?
Well, we submitted an offer with a consortium, indeed, back in October. We are in due diligence phase. We're discussing, but at this stage we haven't found an agreement, neither on the on the format, no on the amount, and so there is no certainty we will reach an agreement, but we're actively discussing.
It sounds like you're pretty doubtful. I mean, this is France's second largest telecom company.
I'm not
SFR.
doubtful. I have to be responsible with the markets, and we've been very clear that...
Is it 50-50 right now?
There is no, this type of deal, it's 4 players discussing one seller. There's definitely one seller, which is something quite unique in this type of transaction, but, agreeing on this very complex transaction, I think everyone agrees on the values and the synergies that the national consolidation would create in France. So we all know there's value to be created, but then it's a typical negotiation, so difficult to put a percentage here.
Are telecoms companies more or less... If you talk about sort of vulnerability, software companies up here, where do telecom companies come in terms of their vulnerability to AI and disruption from it?
Well, connectivity will be essential no matter what. Okay. And actually, even if AI changes the type of traffic on our network, it's and especially with our networks, next generation network, fiber everywhere, 5G, there is no risk on our fundamentals. Then AI accelerates cybersecurity, but we think on the contrary, it's going to be for us a real asset and a real competitive advantage to deliver trusted connectivity, secured connectivity for consumers and for enterprises. Our customers these days don't know if they can click, if they can open an email, if they can open an SMS they receive, and there's really value. And our networks have the ability to provide more secured and trusted services. So we think we're really well positioned.
Just kind of slightly tangentially, but kind of around the same idea. Can Europe rely on Starlink?
Well, as a telecom service provider, we are also a satellite services provider. Yep. We've been providing satellite services complementing our terrestrial networks for quite some time. Now, we're not a satellite operator. We work with existing constellations. And of course, I think we need European solutions, not just American or Asian constellation. But we are also testing American solution, and we've launched an offer in France with Skylo. In Spain, we're testing Starlink. So there is no one monopoly environment. Well, I think Europe needs to have its own solution because, we've seen that what happens in Ukraine. It's very, satellite communication can be a good backup solution, and in some very crisis type of environment, it's important to make sure you have a resilient service, which means you have to have alternatives and plan B, plan A, plan C. So having only one solution is never a good position to be in.
So you're not experiencing political pressure to cut Starlink out and just to focus on Eutelsat and the others?
No, if you look at, first of all, the networks we have in Europe, they're very well deployed. And so we have 99.9% coverage in France. We have fiber rolled out to 96% of homes. So satellite would only provide solution for rural areas. And today, for instance, in France, we have more than 10 million fiber customers when we have, I think, 100,000 satellite and 5G broadband customers. So there's no doubt that satellite is only somehow a niche solution, but a very important one for backup and to provide 100% connectivity.
You've talked about, and the company's talked about trying to, just going back to the AI piece, trying to get revenues around, 600 million euros, AI-generated revenues for the business. Where specifically, is that correct? And where does that come from?
2025, 300 million value, which is cost avoided and revenue generated, and 600 million, so times 2, would be for 2028.
Do you see lower headcount on this AI infusion?
Today, what we see, because we have an aging workforce, for instance, in France, we use AI to automate and to not replace a number of jobs. We don't really see it. To get the full benefit of AI, especially agentic AI, you really need to redefine your company processes to change the way you work. And this is a lot of change management. And in a company like Orange, this is going to take years. So we don't see impact. And we have an agreement in place with Workers' Union where we know what type of jobs will decrease, but we're also creating new jobs in cybersecurity, in data, in AI. So for the time being, it's very difficult to assess.
Christel, nice to see you. Thanks for coming to see us. We really appreciate it. Christel Hydermann, the Orange CEO. OK, let's talk about what is happening with the trade story. The US Trade Representative, Jameson Greer, speaking to CBS Face the Nation over the weekend with a message for US trade partners.
these deals are going to be good deals. We expect to stand by them. We expect our partners to stand by them. And I haven't heard anyone yet come to me and say the deal's off. They want to see how this plays out. I'm in active conversation with them on it.
Nothing to see here. The market may take a different view. More on the market impact next. This is Bloomberg.
Welcome back. This is the opening trade, Monday the 23rd of February, and the futures picture looks like this. If you don't like the red on this screen, then an hour ago it looked worse. But the European equity markets expecting to go just a touch weaker. Uncertainty seems to be the way that we're describing the market psyche right now, Tom, with relation to tariffs. We've got US futures pointing a little lower, E-minis down by 0.5%, and Europe set to be flat to negative.
OK, cash treasuries, meanwhile, advancing in early London trading as investors weigh risks from President Donald Trump's latest tariff plans. For more on markets, we're joined now by Marianne Allier, fixed income fund manager at Carmignac. Marianne, good morning. Should we expect, given potentially lower revenue streams into the US Treasury, for pressure on treasuries going forward?
Well, first, we don't know if there will be lower revenues, as Trump already said that he will replace tariff and it will be 1-for-1. So it's difficult to say at the moment that we will have lower revenues. And looking at that, even before tariff, US rate drift towards 4%. We went from 4.30, let's say, to 4.05. So the market has already even before tariff, be on AI valuation for the moment, and the equity market seems to be more important than tariffs, where nobody knows where we will go from here.
You don't think the recent rally in treasuries is overdone then, Marianne? I mean, there's a case to be made that inflation is stickier, that there's less certainty for revenues for the US Treasury right now. The job market has stabilised. Have things run too far, or are yields looking reasonably priced at these levels? Treasuries looking reasonably priced at these levels?
That's a good question, because you can argue that part of the story is people went to invest in a fixed income just because they were worried about AI valuation, about growth. But in that case, you don't understand why credit spread, for example, were so tight, and where the equity market is not very far from the highest level. So the part of the story is maybe that we know that the Fed is still in the cutting cycle mode, so we know that inflation, even above target, is not the main indicator that the Fed is looking at. It's more unemployment. So I'm in the camp thinking that yields are too low, but it's very difficult to go strongly against the market as a moment where we see some crack in the equity market.
Too low. So what's the right price?
Well, let's say that if you think that inflation, being optimistic, inflation is at target at 2%, you can see that potential growth in the US is between 1.5% and 2%. So, without any premium, anything, yields at the 10-year, in theory, should be around 4%. So let's say you have a bit of premium of 0.5. The right price may be around 4.5 without any, big premium. But it's theory. It's not practical, it's on the long run.
How easy would it be to push US 10 years back towards... Sorry, carry on.
No. What could push 10 years below that? Again, I don't think tariff for the moment is the right question. I think Wednesday NVIDIA result will be the right question for the bond market. Months ago, the equity guys tells us, tell me where the 10-year go and I will tell you where the S&P will go. Now we are the bit on the reverse, where we say, okay guys, tell me where you put the Nasdaq and I will tell you where the 10-year will go.
That's interesting. And so the fixed income market's going to be watching the Nvidia results then, Marianne. What are you watching for specifically?
Well, we are seeing, just to see how the future and how they will continue to invest and to put capex on the table, because part of the US growth is due to AI capex. Part of the US growth is due to the fact that everybody is talking about potential growth being, more important because of productivity and so on. So if we have a bit of less growth, less future bright of NVIDIA, all this story can reverse very quickly. Remember 2000.
Yeah. Yes, indeed. Yes, with all that comes with that. What about going back to the conversation about where yields should be? I mean, do you see evidence that the market is keeping yields, in your view, too low because of the anticipation that Kevin Walsh comes in and rates get cut? What's the impact of waiting for Walsh on these markets?
I don't think that Walsh alone can turn the Fed. Looking at the last minutes of the Fed, you see that the board is quite hawkish, looking at inflation, being quite relaxed on unemployment. So I don't think Walsh alone can overcome, and force the Fed to cut. But for sure, it will be a more dovish member that Powell was. But at the end of the day, I'm not even know if Powell will stay or not. Maybe you have more information than me, but I don't know for the moment.
Yes, we'll plug that one and we'll see. I'm not sure we have got better information, but we'll find out.
No doubt looking for it.
Yes, we are certainly searching for it very, very diligently. Marianne Allier, fixed income fund manager at Carmignac. Thank you very much indeed. Joining us now, Paul Dobson, Bloomberg executive editor for Asian markets. Paul, what do you make of the reaction thus far? We saw a rally Friday into the close as a result of the 10%. Now we've got 15%. We're seeing risks maybe coming off a little bit. What do you make of the market reaction thus far this Monday morning to what we've seen Friday, Saturday, Sunday, over the weekend on tariffs?
Yeah, hi there, guys. So I think that the most salient narrative that we can see out there is a weaker dollar right across the board, and with some of the Asian currencies performing strongly, but not just those over here, but also European currencies too. Secondary, we've got futures lower again for US stocks today. And I think that gives you that sort of impression that all of this is creating just a real sense of uncertainty at the moment. What is Trump going to do exactly? He's changing his mind every 5 minutes. That's not very good for long-term investment plans, and therefore it's not very good for the economic outlook. If people are going to be delaying their decision-making by a certain amount of time, then that's going to hold back the US growth model in particular. And I think that that's what people are expressing in the way that they're trading this morning. Not only that, but on top of it, you've got this idea that the US is actually declaring it kind of faces a balance of payments crisis with the new emergency measures that he's mentioned. Be careful what you wish for, because investment flows have been slowing into the US for one thing, and that may start to take its toll again and bring down the dollar anyway over time.
Yes, I know we've got lots of voices in our reporting from Bloomberg News, Paul, talking about how there is no crisis that in terms of balance of payments. But as you say, we'll see how that plays out in the dollar. Paul, let me ask you about Nvidia, because we just talked to a fixed income guest who was saying that actually fixed income markets are going to be watching the Nvidia story because so much of the growth story in the United States is attached to the build out of AI and to data centers.
Yeah, I thought that was really interesting what she was saying. Tell me where the Nasdaq's going to be, and I'll tell you where the Treasury yield's going to be as well. And definitely these earnings are important. For Nvidia itself, which has been flatlining for 4 or 5 months now, which has seen its kind of valuation metrics compressed somewhat to more or less in line with the Nasdaq. But meantime, we've been seeing that big rotation trade already playing out in the US markets, where the big tech companies have been underperforming relative to the rest of the market. So bad earnings from Nvidia are a miss, and we could see that trend accelerating. We really have to see what they say. If they can restore confidence in the idea that capex is going to be manageable, then maybe we get a boost and that starts to unravel a little bit and bodes better for the US market.
Paul, when mainland China comes back from its holidays and the Lunar New Year festival, does it come back with a bang for Chinese equities?
At last they'll be back with us tomorrow, Tom. And I think that, not only does the catalyst of the tariffs going to be really good for Chinese markets, but actually a lot of the reports that we've seen about spending over the holiday period have been a little bit more positive and favourable for China as well. And so, we have seen Hong Kong stocks already gathering some momentum over the past couple of days. And we see the yuan in the offshore market also trading firm. So it feels like, this is a trend that people are going to be looking for in the opening days, particularly those tech companies and the robotics and other exciting parts of the market.
OK, Paul Dobson, thank you very much indeed. I caught some of the CCTV gala, the Chinese New Year gala, which is an annual event, Paul, and they had this amazing robotics display. And there's often signalling from the Chinese government in terms of what they want to see from the consumer and what their priorities are from this TV extravaganza.
Buy robots.
And robots was part of that. Buy robots, we are leaning in to automation. Interestingly, bits on exports as well. So displaying some of the export prowess
They'll have to do more than just dance, though. That's not reason enough to buy them.
These were dancing robots, but you want one that's more practical, arguably, don't you?
Yes, that makes concrete.
Yes. Paul's concrete.
That just makes me sound really weird. Let's talk about some of the other stocks that could be in focus this morning. JMAT, so Johnson Matthey, mid-sized business here in the UK. Honeywell was looking to purchase a part of it, and it still is, but for less money. Yeah. And so we could see this one weaker. JMAT could be weaker at the start of trade. So they are going to pay 1.3 billion for something they were going to pay 1.8 billion for. So we'll keep an eye on that one. That's just one stock specific. I suppose the trade narrative still looming over these markets. You wonder if the kind of UK comes off worse thing, that doesn't seem to be something that's going to stick to UK-listed stocks necessarily, a bit more complicated than that.
In terms of what we're seeing with crude, I would down by 1.3, 1.2, depending on the contract you're looking at. Do you see oil stocks come lower on that? Do you see airlines go higher on that? It'll be interesting to see how that one works its way through the market as well.
Oil has obviously been volatile. How long does that stick, that downward pressure on oil prices? And that's all dependent on what happens, of course, around Iran. But we're watching that. Bitcoin, to your point earlier, under pressure still. Gold currently up just 6-10%. It had been higher at the start of the session.
And the dollar move, as Paul was saying, one of the most obvious, sort of most concrete, to go back to that theme, most concrete trends that we can see in these markets today. The dollar weaker and lots of other currencies moving higher, including the euro. So we'll see if that actually has a negative impact on some exporters.
We're in the red at the moment, but not by much. We're back in a minute. The market open is almost upon us. Monday morning, good morning. A couple of minutes to go until the start of European equity trading. This chart here is half the story, OK? So Europe goes out here, but this is where the action happens around here. This is when the Supreme Court basically says, no, you can't have your tariffs. Trump comes out. It's a little delayed, the press conference, but then comes out fairly forcibly, puts 10% on. The market goes 10%. That sounds great. Equities go higher. Could have been worse. Could have been 15%. Trump goes, oh, yeah, it could have been 15%. So after this goes, we're going to do 15%. So basically, this is half the story because this morning futures are lower. So basically, you can unwind all of this, basically back to flat from where we started on Friday morning. So in some ways, nothing to see here. But we've got to price in the second bit to Europe this morning, Tom.
That is the uncertainty. And I started at 7 a.m. talking about risk off. Now it's more around caution. I'll reframe that. There's a bit of caution in these markets. European futures then pointing lower by 0.2%. But to your point, after a record close on Friday, FTSE 100 futures a little softer by 12 points. The UK could ironically end up being one of the worst hit as a result of the changes and the tariff uncertainty. DAX futures pointing lower by 131 points, softer by 0.5%. We're watching oil and we're watching what's happening in precious metals as well, Guy.
OK. Here we go. Time for the start of European trading. We should probably do stock futures first.
Yes.
So, single stocks first. Anna needs to talk about concrete.
Yeah, I've got a few of these. I don't think there's any concrete in this morning. Johnson Matthey is in focus. The Honeywell is still buying part of the business, but for less money than previously announced. So we'll watch that one at the start of trade. Rolls-Royce in focus. Other media in the UK was reporting over the weekend there could be a buyback coming this week. No confirmation or denial on that so far. And NL starting a €1 billion buyback and outlining its strategic plan, Guy.
I only have 40 seconds there, and I had far too much time. I'm not sure I can fill 40 seconds. I can probably fill a few seconds, though, before we get this European market open. Here we go. Let's see what's going on. FTSE futures are a little negative, but not by much. It's kind of the picture I think we're probably expecting to see more broadly across the continent. I think probably a flat to mildly negative open is probably the picture that we are looking at. US futures have certainly rolled over a little bit, but if you take a look at the 2-day chart, basically there is nothing to see here. We have done little in terms of changing the trajectory or narrative. Tariffs have changed, uncertainty has grown, but equity markets by and large actually fairly flat as a result of all of that. And that's what you're looking at this morning. FTSE's barely changed, CAC's down by 0.2%, IBEX is actually higher this morning by 0.4%. Tom, what do you got?
Across your sectors, utilities, top of the list right now, up 0.7%. Basic resources gaining 0.6%. Banks also up 0.5%. So you've got, 6 sectors in positive territory so far. On the downside, the biggest losses right now, at least, coming through for tech, which is down 0.9%. Industrial is also a little softer by 0.7%. And again, to the downside, the majority of sectors in negative territory, not by a significant amount, just 6 sectors right now in positive territory. Utilities at the top, tech at the bottom, at least as things stand, Anna.
Yeah, it's interesting that the market, we talked a lot about tariffs this morning, but the market arguably is thinking more about tech and the AI themes, or at least still thinking about them, because the worst performer within that tech sector is SAP. That's the theme we've talked about before, about software. Dassault Systèmes, also weaker, and that takes us back to that software theme. So that's a theme that is living on and cutting through the tariff chaos that we see. Banks actually jumping into top spot now, up by 0.7% for that particular sector. A wide range of banks going higher from France, from Spain. So we'll continue to watch that. Interesting, the German market not open, which is not unusual, but the futures picture was suggesting that we'd see some of the worst pain in Germany this morning, which with trade in mind and exports in mind seems as if it would fit. But the CAC came on actually doing a little worse than had been expected.
SAP is down by 2%. SML and SAP, the two biggest points drags on the market this morning. Siemens is lower. Rheinmetall is lower. So you are seeing some of the German names under pressure, basically defence names and some of the tech names, some of the big European tech names are certainly softer this morning.
NL is now near the top of the list in terms of the energy space, up 4%, and the miners as well. Fresnillo with exposure to silver up 3.4%. And worth noting that Anthropic came out with another cybersecurity update towards the end of last week, and there was a bit of selling pressure across some of the cybersecurity stocks. More. There will be more. And this is the point. We're nowhere near the end of the story, and it's not just going to come from Anthropic. It will come from the other major labs as well.
Well, no doubt AI will be part of our next conversation. Gerry Fowler joins us, Head of Global Derivatives and European Equity Strategy at UBS Investment Bank. Gerry, nice to speak to you this Monday morning. Sure. So the news flow leads me to ask you about tariffs. Market reaction would lead me to ask you about AI. But I'm going to go with tariffs first, because there has been big news flow surrounding this into the weekend and over the weekend. How much clarity do you have on where the tariff story goes and how much it matters to Europe and European businesses?
I mean, our long-held published view is that even though the IEEPA tariffs were struck down, there are alternatives. And so the tariffs are largely in place, likely to stay in place in some form, perhaps in various forms. But it's not the most important driver in markets at the moment, except that it just adds to that sense of uncertainty about US policy. And I think one of your previous guests might have been talking about how policy at the national level like that tends to come through in currency depreciation. So we're seeing a little bit more of that today. But, that currency depreciation is not just being driven by uncertainty, which was really the story of last year. It's now being driven by US investors investing offshore. If I plug one of your tools, the BI ETFS Go has fund flows in ETFs. And it's very clear that US investors are investing a lot more in international ETFs, to the point where actually the scale of investment in non-US specific ETFs in January was more than US specific ETFs.
Yeah, OK. And so let's linger on that then. So we are seeing the tariff story expressed in FX. Dollar is weaker, euro is stronger, and this partly, reflects the ETF flows that you're talking about there. I mean, how much of a headache is 118 euro, 118 for euro dollar, or if that isn't, where does it get to? It becomes a headache for European companies.
I mean, even if we look at GICS level 1 sectors that are exposed to the more significant exporting sectors as compared to the domestic sectors, last year we saw earnings expectations 12 months forward go down about 7%. Largely because of the currency. Maybe there's a little bit of a tariff effect in there as well, but I think analysts really struggled to put that in their estimates. So it absolutely dragged down earnings quite materially last year for certain parts of the market. But the other half of the European market did very strongly. Earnings expectations were up about 8%. So it's just one of those drivers of really, really record-breaking dispersion within the market. 118, fine for now because we've been there for 6 months, but certainly it becomes more of a headwind if the euro pushes on to 125, 130, if these flows from US investors continue continue pushing into international markets, much of which benefits Europe as well as other markets as well, but Europe is big. That flow, which we haven't really seen, that outflow from US investors since prior to the GFC, used to drive very significant dollar down and up cycles. What US investors do with their portfolio flows can be very consequential, and we just haven't seen it for 15 years.
Okay, a couple of things in there I want to pick up on and talk about a bit more. Dispersion.
Mm-hmm.
Why have we got such huge single stock dispersion and index stays where it is?
Yeah.
Index vol on the floor,
and
single stock dispersion massive. Does
Exactly.
index vol come up? Or does single stock vol come down?
So correlation is the defining factor. Are stocks going to behave in a correlated fashion? Well, since COVID, they really haven't.
No.
We've seen multiple dispersions. Back then, it was services versus manufacturing because of the shutdowns and the reopening and the supply constraints. We've had very narrow AI enablement performance, particularly in the US. That's now feeding into Europe, where the AI enablement stocks, the capital goods, the renewables are performing and nothing else is. You've got the Chinese competition dragging on parts of European markets. You've got the tariffs. You've got the currency. Now you've got this AI divergence of who is a winner and who is at risk.
Yep.
So I don't think that dispersion goes away, but certainly if we had periods of correlation, you could very quickly see a lot more index volatility, and we've already seen that year to date.
The impact of that would be?
Well, exactly. So if volatility goes up from, say, 15 to 20, as it has year to date, you very likely get more risk premia being priced in the cyclical parts of the market because they're more sensitive. I think that explains why banks are
Does it bring indexes down, though, more broadly? Because you just have to de-risk.
Well, certainly. So what it might, depending on how cyclically oriented the index is. Europe is fairly well balanced between cyclicals and defensives. It certainly brings the cyclical valuations down, but it obviously supports the valuations of defensives. What it does, I think, though, is degrosses the market. So anyone who has a really significant active position just comes back towards neutral, which is really what we've seen. I haven't seen a lower gross position in European equities for a long time, where it appears that pretty much no one owns anything except ASML as an overweight, and everything else is sort of within a standard deviation of where they've been for the last 5 years or so.
Does that change this year?
Once volatility dies down, I think we get a bit more traction with some of the cyclicals because we are expecting that cyclical acceleration.
Yeah.
We are seeing better performance from the fiscal beneficiaries, the companies that will benefit from activity in Germany. We're seeing good performance from the cyclical value stocks because of just their economic momentum. So I think that we do end up with reasonable performance this year coming through in large parts of the market.
Do you also buy the thesis that Europe is better positioned in this part of the AI story because of the capacity to lean into the energy piece and part of the hardware story, and that there's less exposure on the software front?
So we've already seen a lot of winners outperform, so that's the capital goods and renewables companies. We still like them, and they are generating a lot of cash flow, so that's a big win. But they're pretty expensive and pretty crowded, so you need to be a little bit careful and a little bit more selective, and they're up strongly year to date. The companies that might be disrupted, down strongly year to date. But I don't know that uncertainty is going to abate anytime soon, so let's not expect a sharp rebound. So the battle for alpha is going to be everything else, and the everything else is, can you make use of AI, or are you going to be disrupted by it if you're in the middle? And if you're in the middle and you're potentially an AI adopter, we think you win if you're large, you've got lots of data, lots of documents, and lots of customers. So that puts you into things like banks, it puts you into things like food retail, where Tesco is showing a lot of progress, puts you into transportation, particularly some of the airlines. And through earnings season, these companies are being the clearest about how AI is benefiting them, especially the banks. Really clear metrics saying we are making this much more money or spending this much less money because of AI.
Just on the banks, so this is one sector, yes, has huge amounts of data, huge amounts of knowledge about people, but also I remember listening to one senior executive saying startups in this space can move so quickly. Mm-hmm. Banks, there's so much responsibility, so much regulation, they can't move very fast. Mm-hmm. So how do you fit that into expectations around what they do?
So we've
with
certainly seen a bit of disparity. Obviously, the wealth advisors are perhaps a bit more disruptable because they're primarily providing a service of like informational value, whereas banks, it's a bit different. They customers don't move very much because there's a lot of trust involved, so that's very important. There are a lot of regulations, which creates a little bit of a moat around their business. And the reality is most of what banks do is transactions. So it's an actual, so it's almost like a physical product. You've got to do something in the world as opposed to just provide information. So I suspect that banks are a decent amount more protected from AI disruption for a longer period. But also, these are the biggest companies in the world investing very heavily in AI. And scale matters because the more data, the more processes, the more customers you've got, the more likely it is that AI is helpful. If you're a startup, you don't have the data, the customers, the processes yet. If you can get the scale, it becomes useful. Maybe it helps you get the scale. well. But the banks already have it. So we've seen them beat on cost assumptions versus consensus 9 out of the last 11 quarters. So they're clearly already showing that they can they can contain costs better than the market expects. And I think that's even before we've seen a lot of the AI tools roll out.
One final quick question, just back to kind of one of the earlier points you made. The money that's coming out of the United States, is that seeking safety? Is it seeking cheapness? What is it want?
It's a mix of a few things. So first of all, we did see outperformance of non-US markets to US markets.
Yeah.
We are seeing a lot of the cash flow. So there's an extra $100 billion of capex that's coming from the hyperscalers this year, which is purely driven to cost inflation of memory from Korea, for example. So a huge amount of what the US is spending is actually simply being transferred offshore to the providers. And you've got an awareness that the dollar is still coming down. And so US investors will seek some safety in diversifying their currency exposure.
Is there a belief that if the US markets go down, the rest of the world does better?
I think it is, at this point, to some extent, self-reinforcing, that if the US continues to underperform and the US dollar continues to weaken, it will actually attract more flows offshore because we're starting from a low base.
If the US market went down hard, would the rest...
So that's where it gets a bit more tricky, because as soon as you introduce a lot of volatility that might well be US-led, then it can obviously have a feedback loop on the performance, the economics, and the appetite for risk of investing internationally. So there's this sweet spot that if the US is sort of doing fine, maybe up a little bit, maybe even down a little bit, but not particularly contributing to global cyclical volatility, the rest of the world probably outperforms. If we have a huge recession and a lot of volatility, then all bets are off.
That's the beta. Cool. Gerry, great to see you.
Thank you.
Thank you very much indeed. Gerry Fowler, Head of Global Derivatives and European Equity Strategy, joining us from UBS Investment Bank. Quick look at the core six. This is what we are seeing this morning. As we've just been mentioning, ASML is front and centre, and that stock is down quite hard this morning, 1.75%. Luxury's having a fairly good day. France outperformance. Germany having a less good day. Let's deal with the details. Let's start with Johnson. Charlie Wells, over to you.
A very dramatic drop here, and we're seeing this on the back of that M&A announcement that came over the course of this morning that Honeywell would be buying Catalyst, an enzyme producer, by Johnson Matthey, but at a discount. And it's seeming like the market is not liking that discount. Down 15% so far this morning. Again, Johnson Matthey is saying that they could offer back to shareholders some £1 billion, but it's seeming like that discount news is not coming strong through the markets. Let's flip and take a look at an opposite story that's post-NL. They had some very nice earnings out this morning. They're up over 1%. They projected a solid year going forward as well. That is assuming that de minimis rules, we know that there's a lot of tensions in trade this morning, assuming that de minimis rules do not have a negative impact on their business model. Let's again take a look at Enel, the energy company, because they had some solid numbers coming out talking about dividend growth, and we're now seeing them up over 3%. The company also talking about an ability to invest more in renewable energy. That seems like a story that the market is liking. A story that I think the market is not liking so much is SAP. That, of course, is that tech company. And this really brings together, SAP really brings together two of the difficult themes that we're seeing this morning on trade. Tensions about trade coming from the United States, creating, some turbulence between the U.S. and the EU, and also that tech story that you guys have been talking about, tech under pressure, given that SaaS apocalypse we've been seeing over the past couple of weeks.
Charlie Wells, thank you very much indeed on some of the stocks on the move in this Monday session. Coming up, oil dropping as traders weigh the Iran deal outlook. We're going to discuss the market with Angelina Valavina from Fitch Ratings. That is next. This is Bloomberg.
Welcome back. It is 8:17 here in London, 9:17 in Paris and Frankfurt. And this is the picture across European equity markets right now. Then down by 0.3%. We saw some strength coming through during Friday's session. So if you put the 2 days together, we're not necessarily weaker at all. But the DAX is down by 0.7%, which is interesting. The fact that we are seeing more weakness coming through there in that export-heavy market. Let's have a look at the US futures picture. And we have, although actually it could be some of the tech names like SAP leading us lower on the DAX rather than the export story. Let's have a look at US futures, down by 0.5% on E-minis. The same thing applies about putting the 2 days together, guys. You've been mentioning a couple of times, but interesting that Nasdaq futures down by 0.7% ahead of those Nvidia numbers, which our guest was talking about earlier on.
Going to impact multiple markets. We'll keep an eye on what is going to happen with Nvidia later this week. Let's talk about what we're seeing in crude this morning. So oil is down. You could argue that what we are probably seeing this morning is an unwind of maybe some of the insurance that was bought by traders Friday. Do you want to carry risk over a weekend? Who knows what's going to happen over the weekend? Maybe you buy a little bit of insurance, bid prices up a little bit Monday morning. Maybe that comes out. But we still, I don't think, know what's going to happen next. Investors certainly weighing the odds of a nuclear deal between the US and Iran. We've got more negotiations on the issue expected later this week. But we've also got an awful lot of military kit in the region. Trump very much, again, appearing to threaten Iran, basically saying, make a deal.
They better negotiate a fair deal. They better negotiate. You know, the people of Iran are a lot different than the leaders of Iran. And it's very, very sad situation.
Angelina Valavina, head of EMEA Natural Resources and Commodities at Fitch Rating, joining us to discuss. Angelina, what do you think the market is currently pricing? What do you think is seen as being the kind of the base case, the most likely outcome vis-a-vis the Iranian situation?
Good morning, and thank you for having me on the program. So the oil prices are always volatile, but the current situation with Iran, also with the US tariffs, adds to this volatility. So during the last couple of weeks, the geopolitical risk premium increased to about $10 per barrel for Brent. And the Brent price went up from $60 at the beginning of this year to about $70 yesterday. We do believe that depending on how the situation with Iran will evolve, that will add to the volatility of the prices. But given that the market is oversupplied, it will keep a cap or a lid on the geopolitical risk premium. Our price forecast for this year is $63 per barrel on average for the year for Brent.
Okay, that just coming back to that kind of the market is capped. What we're also hearing is the fact that a lot of the oil at sea is currently sort of sanctioned and therefore may not make it to market. So maybe you can back that out of the current surplus that exists out there. There's also the kind of the question of if there was a prolonged conflict and we saw resources in the Gulf in other countries being hit, maybe that takes a significant chunk of available crude out of the market as well. How firm are you in your belief on that cap, the fact that there is a glut and it will limit the upside on the supply, on the price?
So it remains obviously to be seen whether diplomacy will prevail and tensions will subside. But if not, there are two potential key risks to the oil market. The first one, as you mentioned, is potential material disruptions in Iranian oil production. And the second one is the closure of the Strait of Hormuz. And again, we will need to assess the impact on the markets through the prism of the oversupplied global oil market. So Iran is a sizable oil producer. It accounts for about 3.5% of the global oil production, and it produces 3.5 million barrels per day. It exports 2 million barrels per day. And despite the tight US sanctions, the supply of oil from Iran has been relatively stable. So potential material disruptions in Iranian oil production would add to price volatility. It would increase the risk premium. And we have already seen it because of the buildup of the US military presence in the region. However, as I mentioned, the market is heavily oversupplied. And that should limit this geopolitical risk premium, and also it will put a cap to the upside of the oil price. What do I mean by oversupplied? First of all, the spare production capacity of OPEC Plus is over 4 million barrels per day. Secondly, the global supply growth exceeded the demand growth last year, and we do expect this to continue this year. So last year, supply grew by over 3 million barrels per day. Demand increased by less than 1 million. So that's a significant increase to overcapacity. And then this year, we expect the supply to grow by more than 2 million barrels per day, whereas demand will remain moderate, or demand growth, less than 1 million barrels per day. So this will further add to the oversupplied market.
Okay, so you seem fairly convinced then that we do have this glut and oversupply situation in the oil markets. Thinking about the reaction function of the Iranian regime, Angelina, knowing as you do about their reliance on the Strait of Hormuz themselves to export crude. What do you think? What would be the circumstances where we would see a shutting of the Straits of Hormuz, do you think? And what impact would that have on the global price?
There are maybe two ways of looking at it. If the Strait of Hormuz is closed, the impact will be significant because it is a very important artery for the seaborne oil transportation. Around 20 million barrels per day of crude oil and petroleum products are transported through the strait. And this is about a quarter of global seaborne oil trade and 1/5 of global oil consumption. Alternative routes are very limited. There are two pipelines, one in Saudi Arabia with capacity about 5 million barrels per day, and the second one in the UAE, it's about 1.8 million barrels per day of capacity. Therefore, if there is a protracted blockage of the Strait of Hormuz, there would be material repercussions for the market. Having said that, we don't expect it to be protracted. The reason being is that the strait sits at the intersection of multiple economic and geopolitical interests. So half of the oils which are transported or exported through the strait are from Saudi Arabia and the UAE, and the remaining half is from Iraq, Kuwait, and Iran itself. And then half of the exported volumes are directed to China and India. So if the closure is for a protracted period of time, it will have a very significant and negative impact on both exporting and importing countries. And that's why we believe that is highly unlikely.
Angelina, just on the price view then, around, even if it is a temporary blockage of the Straits of Hormuz, what kind of pricing would you model?
So there will be an immediate reaction of the market, and it will be significant.
Yeah.
So the risk premium will go up quite substantially. But it will depend on how long it will remain closed. And then the market reaction will subside.
Yes. What is the ability for Venezuela to fill any gaps? Is there a bet by the Trump administration that Venezuela can add additional barrels to the market to counteract some of the pressure?
Not immediately. So the interesting story about Venezuela is that it has a very large reserve base. It's about 17% of the global proven reserves. However, it's a very small producer on the global market. It's less than 1% of the global production. So in the short term, it can increase the production by 200,000-300,000 barrels per day, but it's quite small within the context of the global oil market. In the long term, the production increase will be quite challenging because it requires quite a few conditions to be met. One of them is the development of the fiscal framework, which is relatively stable and support the investment in the country, in the oil sector, because the sector is quite dilapidated and it requires heavy investments.
Yes.
And the investments need to be attractive for international players to do so, because quite a few oil and gas companies burned their feet in 2007 when their assets were expropriated. So it's possible to increase production by 1.5 million barrels per day, but it would require a lot of time and it would require investments.
Okay. Angelina Valavina, head of EMEA Natural Resources and Commodities at Fitch Ratings. Thank you. Coming up, as the US threatens military strikes against Iran, then the former UK ambassador to Iran will tell us what we can expect if a new conflict breaks out. We'll have that interview for you next. This is Bloomberg. Welcome back. This is the opening trade. We are 30 minutes into the Monday session. You're seeing a downside pressure then, 0.3% across the regional benchmark. A little bit of concern, a little bit of anxiety. There is uncertainty then as a result of what we've seen on the tariff front. But it's the tech story that is leading the downside when it comes to Germany, with the story around SAP under pressure once again. Of course, that major software supplier on the enterprise front, and you're seeing the DAX down 0.5%. Over in France, the CAC a little bit softer, just down 1/10. A similar picture of the FTSE 100, down 15 points so far. Banks and utilities amongst the leading gainers, and tech feeling the pain. Guy.
Show you some tech in just a second. 242 up, 339 down. Again, we talk about this kind of rotation that we're getting in the markets. You are seeing it cancelling itself out, and therefore at an index level, actually vol remains relatively low. But look at volume today. It is down by nearly 40%. I do slightly wonder, in fact, I'm very much wondering whether or not this is snow day related. It looks like the New York trading story could be disrupted quite heavily today by the weather. Feels like it's almost like a kind of US holiday today in terms of the volume numbers we're seeing. That would be typical of a national holiday in the United States. Let's talk about where we're seeing the leaders. Some of the energy names certainly on the move. You've also got some of the gold mining moves as well being watched quite carefully. So for Neo is up quite strongly today on the back of what we're seeing in gold. NL is up by 3.5%. JD Sports out with numbers, returning money to shareholders as well, as a result of which that stock is up quite nicely. But the action is at the other end of the spectrum, I think, more interestingly. We've got Johnson Matthey trading lower. Looks like the deal that it had done is going to be done at a lower price in terms of selling part of its business. And as a result of which it is down by 15% this morning. But look at the big two tech names out of Europe. ASML is down hard, down by 2.4%. SAP is down by 2%. SAP has dropped nearly a third from its highs to where it is now. Is there more still to come in terms of the downside on that stock? SAP currently trading at 170.52, Anna.
So tech in focus in the markets, trade certainly in focus, and one of the stories we're keeping a close eye on this morning. Senior US officials are saying President Donald Trump's tariff defeat at the Supreme Court won't unravel deals negotiated with global partners. US Trade Representative Jameson Greer told CBS's Face the Nation that the trade deals remain in place and the administration will stand by them, expecting partners to do the same. Hungary plans to block every EU decision concerning Ukraine until oil starts flowing again through the Druzhba pipeline in Ukraine. Prime Minister Viktor Orban says, quote, no war loan can go to Ukraine until oil deliveries to Hungary restart. The pipeline system, which moves Russian crude to Hungary through Ukraine, was damaged in a Russian attack back in January, leading to a halt in shipments. US President Donald Trump says he is considering limited military strikes to pressure Iran into signing a new nuclear deal. Oil fell as investors weighed the odds of a nuclear deal between the US and Iran, with more negotiations on the issue expected to take place later this week. Tom.
Let's get more insights on that story. Joining us now for a discussion on the situation in the Middle East, Rob Macaire, former UK ambassador to Iran from 2018 to 2021 and Chatham House Council member. Rob, thank you for coming in. What is your current best assessment as to what President Trump does when it comes to Iran?
Well, there is a feeling of inevitability about this huge military build-up, isn't there? But I would say that even at this late stage, President Trump's preferred option would be to get a deal and get him off the hook of military action. As long as that deal is better than what all his predecessors have got with Iran, and if you look at the words used by Steve Witkoff over the weekend about capitulation, I think that gives you a sense of what the US would want out of this, and I'm not sure that that is available from the Iranian regime.
Because there's a debate, isn't there, as to the nature and the contours of the deal, to your point, and as to whether or not it sticks firmly to the nuclear ambitions of Iran or starts to include things like the ballistic missiles and their support for proxies. Israel has a view on this. Do we understand what the Trump administration, how narrow they are prepared for this deal to be at this point?
Well, there have been conflicting signals from the Trump administration, of course, but I think that they probably would be prepared to do a nuclear-only deal if it was a really comprehensive one. That would be my estimation. And if you look at the sort of leaks coming out of Tehran about what they would be prepared to offer over the last few days, it's really where this negotiation you'd always expect it to go in an end state. It would be a de facto suspension of enrichment, at least for a period, and inspections, and the sort of things that Iran's prepared to give. But it's still, it sounds like it would
This was the Obama-Iran 2015 deal, essentially, that Trump nixed, and now he's trying to revive.
So it would look like that, and I think that's why they would have to have some actual stopping of enrichment, to a more comprehensive degree to get it. And I think that, as I say, that they are looking for Iran to capitulate. I think that the way that the president thinks is that with this much military force in the region, Iran will blink and they will cave to a really serious deal. Which he can declare victory on. And I just don't think that's the way that Iran thinks. I don't think.
Why not?
Because I think for the regime, their whole ideological setup, and this is all being driven, of course, by the supreme leader, who is old and unlikely to change his thinking, is about resistance. And so if they will see themselves as if they can do a deal that lifts sanctions and still come out with their heads held high, they would do it. If they are seen to surrender to the US, That's really undermines the whole rationale of the regime, and they would probably see taking military strikes with the potential for that at least rallying their base, if not the wider population, as being a less bad option.
In the first option, how vulnerable do you think the regime would be? If you were to see that situation evolve, would they be a credible force still within Iran? There's been significant domestic pressure.
That there has, and of course they have a huge amount of domestic power, and as long as they have their core base loyal to them, they will be able to deploy more force onto the streets than unarmed demonstrators are able to do. So their ability to keep power in domestically is still strong, but there are divisions inside the regime. There is an increasing lack of credibility as well as legitimacy, and so that sort of potential for political change, for change coming from within, is I think what we need to watch.
Yeah, that's a really interesting dynamic, because I was going to ask you, what role do the protests play from a US perspective? Because we have mixed signals there as well. President Trump saying sometimes help is coming, and at other times putting the focus entirely on a nuclear deal and not really talking about the protest activity. But is there something then brewing domestically that is worth paying attention to when it comes to the regime?
The regime is still looking very vulnerable, very paranoid, is doubling down and trying to just to maintain its power. And there are clearly divisions inside the regime about how they should go forward. But for the US, as you say, the choices are military strikes. If you're going to have military action, are you just going to do another version of what happened last June, take out the nuclear and ballistic missile programs, or are you going to do a really comprehensive military campaign that tries to topple the regime? And of course, if you deploy enough military power, you might collapse the regime, but you might also collapse the state. And at that point, the risks are obviously extremely high for the region, for the US, for escalation, and for the people of Iran.
And do we have a sense of what the end goal is here for the US? Because they have oscillated between talking about the human rights record on the ground and the protesters, and then also just focusing on the nuclear side of things. So do we have a sense of what it is that they want to achieve by the end of this?
Not really. I think that President Trump is keeping his options open, and I think, if he could get a nuclear deal that was perceived as a strong one, I think that would be a good option for not having to go to war. I think that there is a risk in just doing some limited strikes that then aren't seen to be helping the people inside Iran, because obviously there's a lot of pressure from Israel and from more hawkish voices inside Washington to try to topple the regime with military power. But the risks that come with that are considerable. So there's no really attractive options here unless you get that deal. And the deal just seems to be really, really a slim chance of getting it.
Rob, what are the Saudis, the Qataris and the Emiratis likely to be telling Trump at this point?
I think they're all going to want to try to avoid a military action that could just escalate and put them in danger. Puts them in danger both directly because of hosting military bases, also economically. You were talking earlier about the Straits of Hormuz, which is the threat that Iran's always liked to wave whenever this situation comes up.
Do you think that threat is real now?
I think they could do it. I think it's a very unattractive option, really, for Iran, because not only because it hurts their own exports, but because once you've tried it once, they will know that the US will have a counter plan, and it will involve clearing mines and probably taking out the Iranian Navy completely and a number of other things. So they will, once you've done that and then it's Straits have been reopened, you've pulled that lever and you're then looking more like a paper tiger.
Is the real danger here you mentioned it earlier, a failed state in Iran? What does fragmentation look like, and what are the implications of it?
I think that's one of the biggest risks, and I think it may be a risk that the outside world needs to take more seriously, because if you look at the impacts that we've had from other countries in the Middle East that have degenerated into internal conflict and civil war, Iran is a much bigger country, and it's 3 times the size of Syria in population, and the impacts in terms of regional stability and obviously extremism, terrorism, refugee flows, regional conflicts, because all of the neighbouring states would have an interest because of cross-border populations. So it could get very bad, and I don't think that's inevitable, but I think that if the central authority in Tehran did collapse, it's a very serious risk that you would see.
Who's the biggest power in that? Is it the army? Who is the most likely next force to run Iran?
So if there was a very chaotic situation and conflict inside the country, you'd expect that in Tehran, the IRGC, who already wield a huge amount of power, but quite a lot of it behind the scenes, you expect they'd probably step forward and take power more overtly. That's one quite likely scenario. But if they are weakened, distracted, decapitated by military strikes, and you see other parts of the country, with Kurds or Baluch or the Arabs or others wanting to run their own affairs more, you could see some quite serious geographical splits in the country.
Yeah, the IRGC doesn't sound much like the regime change that maybe some people have been suggesting. Will President Trump and his team be taking a slightly more positive read across from the more recent developments in Syria? Because yes, the history of that conflict is protracted and awful. But more recently, their experience of it has been, perhaps in their view, slightly more positive. Will they be looking at that as any kind of test case?
I think it would be a mistake to look at it as a test case because, of course, it's a very different situation because you had an organised militia that was holding part of the territory, which when the Assad regime weakened out and hollowed out and eventually collapsed, you had a force that could take over. It wasn't a representative force, it didn't represent the whole of the country. But because al-Sharad took a fairly progressive view of saying, this will not be an Islamist regime, that's going to be sort of persecuting Alawites and the Shia, it has taken on the capacity to be a national government. Now, there isn't any equivalent to that in Iran, which doesn't mean to say that you couldn't get to the sort of outcome we'd all like to see, which is a more democratic, more representative government replacing this current regime that's better for the outside world and better for the people of Iran. It just feels like the pathway to that is incredibly narrow.
Rob, the leader of Israel, Prime Minister Netanyahu, of course, was in Washington recently meeting with President Trump about this issue. Where do you think Israel sits? Does Israel want to see the US take decisive action against Iran at this point?
I think the answer to that is probably yes, and probably they would like to join in as well, I would have thought. And in terms of the risk we've just been talking about of a failed state in Iran, which is at one extreme end of the spectrum, now that's really bad for Iran's neighbours, it's really bad for Europe because of refugee flows, it's really bad globally in terms of security and the risks of extremism and terrorism. But it's probably not the worst outcome for Israel. So I think the way that they would see it would be that's not necessarily the worst thing that could happen.
OK, Rob Macaire, thank you very much indeed. Really important and valuable insights as we weigh up the potential options, or at least the Trump administration continues to weigh up those options. Thursday in Geneva is the expected continuation of the talks between the US and Iran. Rob Macaire, Chatham House Council member and former UK ambassador to Iran. Coming up. According to research from Bain, the dry spell facing the private equity industry is now worse than the 2008 crisis. So just how much, in terms of unsold assets, is the industry sitting on? The answer when we come back. This is Bloomberg. Welcome back. Now, before the break, we asked you how much, in terms of unsold assets, is the private equity industry holding on to? What is the value? The answer is $3.8 trillion of unsold assets. This is according to new research from Bain. Private equity returned fewer profits to investors for a fourth straight year as the industry sits on this huge pile of unsold assets and struggles then to raise money for new funds. Distributions as a percentage of net asset value remained at 14% last year. That's the second lowest level since the depths of the 2008 financial crisis. And the duration of the rut is even more severe than when private equity firms faced back then. The value of deals in 2025 did rise 44% from a year earlier, but that was fueled by large transactions, big ticket transactions, including the $57 billion take private of Electronic Arts. But still, that made little more than a dent in the industry's so-called dry powder or money available to invest. So a lot of dry powder still, and those assets still contained by private equity, struggling to shift them off their balance sheets, Anna.
Yeah, I like how we put the title in French. Very nice. Right, let's talk about some of the other things on our agenda for this week, Tom. EU lawmakers will be meeting 1:30 p.m. UK time, that is, to reassess the bloc's trade deal with the United States. More on that in just a moment. We're also listening out for Christine Lagarde speaking today. Tomorrow we get State of the Union. That's the big address we'll be watching for, which happens to fall on the day that will mark 4 years since the full-scale invasion of Ukraine by Russia, of course. Germany in focus on Wednesday, as it will be, in fact, in 12 minutes' time when we get the iPhone number. And on Thursday, we get a by-election in the UK and some inflation data out from various parts of Europe. Guys, but let's go back to the beginning of that list and talk about trade and where the trade story goes next.
It was quite a fun weekend, as everybody tried to figure out exactly what was happening. We basically are having an emergency meeting by the Europeans today as they try and figure out exactly what they do. The European Parliament's trade chief is set to propose for freezing the ratification process of the EU's trade deal with the US. That's until they have more details from the US side. The US side is basically saying nothing's changed. You shouldn't change your side of the deal. We've changed ours, but you shouldn't change your side of the deal. Let's figure out what is therefore going on. Our trade czar, Brendan Murray, joining us around the table. Good morning. What has changed?
Well, the tools have changed, but the tools are important. The Trump administration said repeatedly over the weekend that this will provide continuity, this will provide certainty. But if you're on the receiving end of those new tools, you really need some clarity, and that's why I think we're going to see the Europeans put the brakes on the process that they still need to do to fulfill its end of the U.S.-EU trade deal. And so they're going to need to talk to Jameson Greer at the USTR to figure out how does this 15% apply to the most favored nations deal that we cut with you several months ago in Turnberry. So and the Europeans aren't the only ones who are going to want to try to figure out what those deals now mean in this new paradigm that the president has laid out over the weekend.
Brendan, is it about kind of getting more information from the Trump administration, or are they going to start to rethink whether or not they want to renegotiate these deals? I mean, if it's not the European Union, then maybe China, as it thinks about that visit from the president. How much leverage does China have at this point? It doesn't have an official deal with the US, but will some of these deals be reworked as a result, and how much leverage does China now have?
Well, one of the statements that came out on Friday that got overlooked was the one from the U.S. Trade Representative, where he said, these are the kinds of 301 investigations we're going to go after. It's going to be unfair pharmaceutical practices. It's going to be unfair treatment of U.S. technology companies. It's going to be a whole host of things.
It's a long list, wasn't it?
Digital services. This is a big area where the U.S. administration is listening to what big tech wants, and they want less regulation, less digital services taxes. So these particular 301 investigations are going to lay the groundwork for the new tariffs that are going to come. And whether you're in Beijing or in Brussels, you need to know how those are going to land on your exporters.
Well, specifically for Brussels, then, Brendan. I mean, that sounds bad for Europe, doesn't it? Or from a Brussels perspective, this sounds like a lot of uncertainty around how tech is going to be treated and what the response to European policy around US tech is going to be. And so I suppose, is that the argument for pausing? Because actually the tariff rates, the emergency tariff rates that have now been put in place don't look all that different from the deal that was struck at Turnberry, a little bit different maybe, and it's a lack of clarity. But is it the fear of what comes next around big tech that means that Europe pauses?
Absolutely. This is where the trade war that's mostly been fought in goods goes into the realm of digital services. The U.S. and the Europeans see things completely differently when it comes to regulation, taxation, and putting tariffs on digital services. And this is where the trade war goes digital.
OK, Brendan, thank you very much. Brendan Murray, our trade czar, with that important update. So this is just one of the things that we're dealing with this morning, the market impact, of course, of the chaos that the Supreme Court ruling has caused. Let's look ahead to other market themes this week as well. Adam Linton is with us from our Markets Live team. Adam, let's start with the trade narrative, or perhaps ask how long do you think this week this is going to be the key driver? Because we see some risk-off evident in US futures, but if you put Friday's session in there as well, we haven't moved all that far. I mean, how long is this going to remain a dominant theme, do you think, for markets?
Yeah, I mean, it's definitely something that's not going to go away. We've got a relatively light calendar this week, so it's obviously going to remain relatively thematic. It's just about how much noise we get in the interim. I think, Friday's ruling, raises a lot more questions than it answers. I mean, we know that the Trump administration is still, very strong on tariffs. We know that they have other tools at their disposal. So we've now just got this period of uncertainty. There's a lot of positivity. Some people are trying to impress that, the EU now has more, leverage in negotiating with the US. But I don't think that's necessarily the case, because if you're a European corporate, all you've got now is just a way more uncertain environment than you had, this time a month ago. And, we're kind of doing this on and off dance with this, EU-US trade deal. So it's really not provided much clarity at all. And then in the interim, you've got Trump going 10%, next day it's 15%. Who knows what he's going to do throughout the week. And we also, we don't know the composition of any future tariff measures he's going to take. I mean, if he goes to a more sectoral approach, as Brenda has mentioned, pharmaceuticals, tech, what do you immediately think of? You think of the EU. So I think, these trade tensions, in absence of any other, potential macro drivers this week, are going to be incredibly thematic.
Is NVIDIA going to save us from all that?
Well, it depends, doesn't it? Because it does have, huge macro consequences. Yeah. We saw, the US GDP forecast. A lot of that is very reliant on this AI data center build out. So, if that's looking at, signs of wavering, that could be a perfect cocktail. We've got trade, we've got, negative AI, then that all of a sudden becomes something, even more thematic. And, for US tech trade as a whole, yes, we're looking for answers, how much efficacy do we get from this large capex spending in the US? But a lot of the issues still aren't really going to be resolved this week either. There's still a lot of concern about AI adjacent companies. Who's going to be next in the firing line from some of these AI benefits? We don't know much more about this. And whilst there will be a floor for US tech valuations at some point, which will entice people, I still think that in the interim, people are going to be more favoured towards Europe to some extent, albeit, as we mentioned, trade is a big overhang. But Asia, we saw the price action overnight. Yeah. Hang saying that was up over 2%. So, and these are themes we've already seen throughout 2026, and I expect them to remain in place.
So, Adam, fold those two things together then, the trade uncertainty, the tech piece and NVIDIA and the role that plays with that outperformance that we've seen year to date for European equities versus the US and, more prominently, Asian equities as well. I mean, does this accelerate that theme or does it undermine it because of your point about the vulnerability potentially of Europe?
Well, I think you may see a bit of an increased divergence between Europe and Asia here. If you're a European corporate, as I mentioned earlier, this is just heightened uncertainty. So you may get to a better end destination, but the path to get there is incredibly uncertain. Yeah. Whereas in Asia, we've seen a lot more winners. You've seen the effective tariff rate go down for India. We've seen it go down for China. China arguably has more leverage. So you may see an increasingly selective approach for equity traders.
OK, need to be selective as maybe the US looks at those different sectoral tariffs. Adam Linton from Bloomberg's Markets Live team. We touched on the euro strength with our previous guest as well, 118. Yeah. They're talking about levels of 125. Maybe that's where the concern comes through. But how much strength do you get on the euro if you start to get these sectoral tariffs under these different tools that the administration has?
Let's see what the German data tells us.
Yeah.
Because that's coming next.
Yeah, it is, absolutely. And we get GDP the middle of the week. But yes, in 4 minutes, less than 4 minutes, we get the iPhone number. And some of the PMIs have been suggesting that we've seen an uptick in the manufacturing side, that the fiscal push in Germany is starting to push through into different parts of the economy. And so we're looking for any evidence of that. With that in mind, Clemens Frost is going to be joining the team in the next hour on the Pulse. So the IFO Institute president will be with the team. And Estee Lauder CEO will also be on the Pulse. Not related to the German fiscal push, I don't think.
I very much doubt it. The US looks like it's going to have a very quiet day today. It looks like the weather's going to be a big factor in terms of what we see in terms of trade. You're already seeing that in the volume numbers out of Europe this morning.
That is it for the opening trade. The Pulse is up next. This is Bloomberg.